Good morning and welcome to our channel, Banking and Finance 360, where we delve deep into the intricacies of financial management. Today, our focus is on corporate finance, an essential component of business strategy that encompasses how companies obtain, allocate, and oversee their financial resources to maximize value for shareholders and ensure sustainable growth. By the end of this video, you'll grasp the key principles, objectives, and practical applications that underscore this vital area of finance. Corporate finance is fundamentally concerned with several objectives. Firstly, the paramount goal is to maximize shareholders' wealth. Achieving this involves enhancing the market value of the firm through strategic business decisions. Companies aim to ensure adequate liquidity, which allows them to meet their financial obligations while pursuing profitable growth opportunities. Another critical objective is to minimize financial risks while ensuring stable profitability and long-term sustainability, a balancing act that requires keen insight and expertise in financial management practices. The importance of corporate finance cannot be overstated. It plays a crucial role in enabling businesses to raise capital for expansion projects, purchase essential equipment, and fund research and development activities. Effective corporate finance practices empower businesses to manage their daily operations efficiently while simultaneously driving business value upward. Additionally, solid financial decision-making supported by corporate finance analysis aids organizations in navigating the complex economic landscape, ultimately leading to enhanced competitiveness and market positioning. When we discuss corporate finance, we categorize its functions into three core areas: investment decisions, financing decisions, and dividend decisions. Investment decisions, often referred to as capital budgeting, involve assessing where to allocate resources, such as building new factories or launching innovative products. Financing decisions focus on determining the optimal mix of equity and debt to fund investments, with attention to cost and risk implications. Lastly, after profits are earned, the dividend decision pertains to determining the balance between distributing dividends to shareholders or retaining earnings for future endeavors. Through these interconnected functions, corporate finance provides a framework for making informed and strategic business choices. Corporate finance encompasses various aspects of managing a company's financial resources, primarily focusing on maximizing shareholder value. At the core of corporate finance are sources of finance categorized into internal and external sources. Internal sources include retained earnings, which provide a self-funding avenue from profits, and the sale of assets, which can generate immediate liquidity. Additionally, operating cash flow reflects the cash generated from daily business operations, underscoring a company's financial health. These internal methods can be efficient, but companies often turn to external sources when more capital is needed. External financing can be derived from equity shares and preference shares, allowing businesses to raise funds from investors in exchange for ownership stakes. Bank loans and corporate bonds are essential debt instruments, with each offering varying terms and obligations. Venture capital and private equity represent significant financing avenues for startups and expanding businesses, providing both funding and management expertise. Leasing, as an alternative financial strategy, enables businesses to acquire assets without a massive upfront investment, thus preserving cash flow for other operational needs. Capital budgeting is another critical area, involving the evaluation of long-term investment projects to determine their viability. Common techniques such as the payback period, net present value, and internal rate of return help assess whether these projects will enhance shareholder wealth. A well-defined capital structure, balancing debt and equity, aims to minimize capital costs while ensuring the necessary financial flexibility in fluctuating markets. Understanding the cost of capital, which includes the cost of equity and cost of debt, is vital for making informed investment decisions, as it represents the return necessary to satisfy stakeholders. Financial planning encompasses forecasting future financing needs, expected revenues and expenses, forming the backbone of a company's strategic direction. Effective working capital management, achieved by balancing current assets and liabilities, ensures that businesses can meet their short-term obligations and finance daily operations seamlessly. Furthermore, identifying financial risks such as market, credit, liquidity, interest rate, and foreign exchange risks is crucial for sustaining operational stability. A corporate finance manager plays a pivotal role, overseeing financial planning, investment analyses, and capital raising strategies. Their responsibilities extend to managing cash flow, budget preparation, and risk management, all while ensuring adherence to regulatory frameworks. Ultimately, financial statements, including income statements, balance sheets, and cash flow statements, provide vital insights for stakeholders, helping assess a company's performance through key ratios like liquidity, profitability, solvency, and efficiency. These metrics facilitate informed decision-making and guide strategic planning in corporate finance. Corporate finance serves as the lifeblood of a business, providing the essential framework for making critical financial decisions. Consider ABC Limited as a case study. They are undertaking a significant investment to establish a new manufacturing plant, costing PKR 500 million. The choices made by the finance manager in this scenario become crucial as they decide to secure PKR 300 million through a bank loan while raising the remaining PKR 200 million via issuing ordinary shares. These financing decisions create a pivotal moment for the firm, as successful project execution hinges on generating annual profits that exceed the financing costs, thereby enhancing corporate value and boosting shareholders' wealth. However, navigating the landscape of corporate finance is not devoid of challenges. Economic uncertainty looms as a perennial threat that can stifle investment confidence, while inflation and high interest rates can erode profit margins and strain cash flows. Concurrently, currency fluctuations present an additional layer of complexity in international dealings, potentially impacting project profitability. Moreover, regulatory changes can impose sudden shifts in operational costs and compliance requirements. Compounding these issues are technological disruptions that can shake the foundations of established markets and intense competition that continuously challenges a company's market positioning. Additionally, political instability can create a volatile environment, rattling investor confidence and further complicating the financial landscape. Despite these myriad challenges, effective corporate finance strategies can yield substantial benefits. Organizations that master their financial processes often enjoy higher profitability, resulting in robust cash flow management and an upward trajectory for shareholder wealth. Sustainable business growth becomes attainable, as firms can invest in innovation and expansion without succumbing to financial risk. With sound financial management, businesses foster stronger investor confidence and improve creditworthiness, making it easier to attract capital for future projects. Ultimately, the three core decisions of corporate finance, investment, financing, and dividend policy, empower organizations to navigate risks while striving for sustainable growth and long-term financial success. As we wrap up this discussion, remember that corporate finance is not merely a set of practices. It is the strategic backbone that enables businesses to thrive. Thank you for watching this video. I hope you found it informative and valuable. If you enjoyed this video, please like, share, and subscribe to the channel for more educational content. If you have any questions or suggestions, feel free to leave them in the comments below. See you in the next video. Until then, take care and keep learning.